I'd like to introduce Tom Ducey, who I'm sure most of you are very familiar with from the Arizona Chamber, just to say a quick hello. Hi, Tom. Welcome.
Hey, everyone. Good morning. Welcome to our kickoff webinar to introduce the Arizona Chamber's newest member benefit. Talking to our members, workforce is always the #1 issue that they're facing. We think that this health plan that is both affordable and available will be greatly beneficial for recruiting new employees, as well as retaining current ones. So we're excited everyone's here. And with that, I'll hand it off to Kyle to start his presentation.
Excellent. Well, thanks, everybody. Amy, am I good to go? We're all set? Perfect. All right. So thanks, everybody, for joining today. Our topic that we're going to be talking about is navigating the medical insurance landscape. And we won't be able to cover everything. As you can imagine, this is a pretty complex topic that has multiple facets. But what the purpose of this is going to do is give you an orientation to understand the key concepts that you need to know as you're navigating this and make you a better educated consumer, right, in the marketplace as you're evaluating the options available for your employees. So we're going to start with, Amy, it looks like I'm not able to share my screen. Can you enable screen sharing? But we will start with...
for you right now.
Okay, great. We're going to start with looking at the 4 major types of group medical insurance, and then work our way a little bit further into the weeds, if you will, on our way through. So the first medical plan concept that we're going to take a look at is HMOs. So there are 4 major plan types or network designs that you're going to run across in the marketplace. And the first one we're going to take a look at here is the health maintenance organization. So HMOs are entities that provide health services while also offering health insurance. And HMOs really emerged, and this is a trend that you're going to hear consistently as we talk through this presentation, that these plan designs, these network types, all these have emerged and evolved as a way to help control costs as it relates to medical care, right? And the HMO is really kind of the first iteration of that. These first started appearing in the late 1970s, early 80s. But the idea here is that as both the provider of the care and the insurance company, right, there's a lot more efficiency as it relates to billing and adjudication of claims, so that there can be a much more lower overhead as it comes to administering cost and care. So prior to starting EP6, I have a background in implementation of electronic medical record systems, and was a hospital billing specialist. So part of what I did was help these organizations set up their contracts with different insurance carriers. And one of the things you may not be aware of is that the typical time it takes for a hospital to receive revenue for the result of a service provided is anywhere from 90 to 150 days, right? So and a lot of that has to do with back and forth claims adjudication, right? So by eliminating the need for a billing department that is solely responsible for getting dollars, right, and adjudicating claims, they can significantly lower their overhead. In addition, HMOs are going to require that members seek care at their facilities. Now, this doesn't mean that you won't have access to emergency care. This is one of the bigger concerns that employees have as they're navigating their medical insurance, is if they're offered a narrow network, exclusive network, or HMO plan, if something happens while they're out of state or not nearby one of those in-network providers, are they going to go bankrupt because they have to go to the emergency room? And emergency care, life-saving care, must be provided without network limitations. It's a federal law, so that they're always going to have access to emergency care. Once their condition is stabilized, they will be required to move to a facility and network. But by requiring that they only see providers at organizations or facilities that they own, again, they're streamlining that billing and overhead process. And then there's one other measure in this that's designed to help keep cost or control cost as it relates to care, and that's the primary care provider. So HMOs require that their members have a primary care provider who coordinates care on their behalf. And before they can see a specialist, they have to seek care from that primary care provider in order to make sure that the care is legitimate, right? The theory behind this is that if you have an unrestricted access to specialists, members will seek care from specialists that could have been treated in a primary care or ambulatory facility that is significantly lower cost. So the idea by coordinating through your primary care provider, they can filter out the care and direct you as needed, and really meant to be that quarterback of your care experience. And again, that coordinated care experience allows for that lower cost, while also giving employees more of a one-on-one touch with their care experience. Typically, there is a requirement to enroll in an HMO that a member has to live or work in the service area. And again, that's designed to make sure that they have ready access to care in facilities that are in network or covered. PPOs are the next type of insurance we want to take a look at here. And PPOs are by far the most common plan type, or have been, as costs emerge, right? We're seeing more of that diversify. But this is often what people tend to think of when they're thinking of health insurance. I have a network of providers, and then there's out of network, and I'm going to pay more if I go to see somebody who's out of network, right? And that's really the whole purpose of this, is that PPOs are a network organization of providers that are negotiating with an insurance carrier for a set of reimbursement, standard reimbursement on services. And the PPO, right, they're negotiating a lower cost for them, that insurance carrier, and those providers are accepting that lower cost in exchange to have employees funneled to them because they're in network, right? If they go to seek care out of network, they're going to have a higher out-of-pocket cost, higher cost share as part of that, and that's to incentivize them to stay with those preferred network providers. PPOs offer the most flexibility, right? There's no PCP requirement. It may be specific to a plan that's designed, but in general, PPOs do not require that out of the gate. So it's not a gated plan. That's what's referred to when you need a referral to seek specialist care. You also have the ability to see somebody in network or out of network. Just understand that if you're going out of network, it's going to cost more, right? And some PPOs may offer a more narrow or skinny network. You may hear that referred to as well, simply to lower the overall cost, but provide options for care out of network. Some employers have gone that route because if the network is smaller, there's less cost to maintain that network. The next two plan types really emerge as kind of hybrids of HMO and PPO. So if you can think of, cost as a spectrum, typically your HMO plans are going to be the least expensive, right? Your PPO are going to be the most expensive, and then POS and EPO tend to fall right in between. Point of service plans are, similar to an HMO. They're required to have a primary care provider. However, unlike an HMO, you can seek care at a facility that's not owned by the insurance company. And you also have the ability to see someone out of network, right? But you are going to have to get a referral from that primary care provider to see a specialist. So there's still the ability to filter some of that care, right? So that folks not be going immediately to a specialist to seek care, which is more expensive, but they have the ability to get care out of network. The last plan type here is that exclusive provider organization, EPO. And again, a blend of an HMO and a PPO plan. Like an EPO, or like a HMO, excuse me, there is no out-of-network coverage. And that's why, that one-letter difference, right? PPO, EPO, preferred provider organization, exclusive provider organization. In the exclusive provider organization, you have to see a provider in network. But you don't have the PCP requirement that you do with a point of service plan or an HMO. So you have the freedom to go see a specialist without first seeing a primary care provider, but it's not going to be someone that you can see out of network. So one of the pieces we'll send out is this slide deck, and I put together just a simple chart here to give you some key indicators about the different types of plans you see here. So the next concept we want to tackle is the high deductible health plan. And I promise I'm not going to read all of the text that's to the screen on you here. We're going to cover this more of a high level as we're moving through. But high deductible health plans have significantly grown their presence in the market. And I should note that high deductible health plans are a very specific type of health insurance that falls into a category based on qualifications under the IRS. So in 2004, again, in response to emerging healthcare costs, a trend pushed in the industry and ultimately made its way into legislation on the idea of consumer-driven healthcare model. The idea that if you push the cost sharing to the front of the plan, right, so there's not first dollar coverage, someone is responsible for paying that cost up front until they've satisfied their deductible, they're going to be more cognizant about the care that they're consuming. Again, the idea behind this is that try to filter out unnecessary care, right, or make more folks cost conscious of the care that they're seeking. Now, when high deductible health plans were first introduced, there was 100% of any covered service was subject to the deductible up until you had satisfied that amount, right? With the Affordable Care Act's passage, there's a requirement that certain essential services required minimum essential coverage are covered without any cost share for the member. So now on high deductible health plans, HSA compatible plans, there's still the deductible is going to be required for all care except those preventative services as defined by the Affordable Care Act. So that's one of the things that's important to understand about offering a high deductible health plan or an HSA plan is that employees still have the ability to access preventative care without a copay or without it going to their deductible. It's only when they start seeking diagnostic care or preventative care that's not defined as essential under the Affordable Care Act where they're going to have to pay any deductible exposure, right? And typically the biggest barrier to folks participating in a high deductible health plan is understanding exactly what those costs are and the tools that they have available to them, like a health savings account or voluntary benefits to help cover that deductible exposure. Because for young, healthy employees, members, persons that are not frequently going to the doctor, they're well suited for a high deductible health plan and can save significant amounts of money on premium, and they can shift that into a health savings account, dollars that are going to follow them, that are pre-tax, and allow them to help cover some of that cost versus paying a higher premium where those dollars never make it back to them, right? The premium is held by the insurance company. So that's part of what we do in partnership here is explaining and helping employees understand how these plans function. Having a high deductible doesn't make something an HDHP as defined by the IRS and compatible with an HSA. The specific criteria, again, is first that they're all services must be subject to the deductible. You may have some plans that have a high deductible, but there's copays for going to see your primary care provider when you're sick, or there's copays on labs or something like that. On a high deductible health plan, everything is subject to the deductible with the exception of those essential preventative services as defined by the Affordable Care Act. And the deductible must be at least $1,500 for an individual, $3,000 for a family, that's a minimum. And then the out-of-pocket maximum, and these are the 2023 numbers, cannot exceed $7,500 for single or $15,000 for family. High deductible health plans can be an HMO, a PPO, a POS, or an EPO. The type of network does not determine whether or not it can be a high deductible HSA compatible plan, okay? And the last thing to note when we're talking about services subject to the deductible, and this is true of all coverages or expenses subject to the deductible, it's not just on high deductible health plans, but it's more front of mind because the deductible exposure is much higher on these plans. But for services subject to the deductible, the member gets the negotiated or discounted price of the service, right? So the provider may say, I charge $5,000 for that procedure, and the insurance company has a contract negotiated with them where they only pay $3,500 for that procedure. If it's subject to the deductible, the amount that's charged is $3,500, not $5,000, because that network savings still applies. It's just the member's responsibility before the health insurance plan is going to kick in. The next topic we want to talk about here is the idea of self-funded and level-funded plans. So most folks, when they think about medical insurance, think of a fully insured health plan, which would be like, your Aetna, Cigna, whatever you think of it, right? A health insurance carrier, you're paying premium, and the risk is assumed by the insurance company. That insurance company is responsible for all the claims in that contract. They're paying for it. They're the ones that are negotiating the fee schedule with the provider. They're facilitating payment to the organizations, which means that they hold all of the cards, right? They have the ability to control what plan designs will look like. Rate is going to be determined based on the group's evaluated risk, right? So what's that pool of employees and what's that risk exposure? On the other side of this is self-funded. I'll come back to level funded in just a second, but again, looking at kind of both ends of the spectrum. So a fully insured plan is where all the risk is carried by the insurance company. On a self-funded plan, the employer actually acts as the insurer, right? The guarantor of those claims. They're the ones that are actually paying those claims and responsible for setting up a network, so on and so forth. Now, employers are not actually taking on the process of processing their own claims and going through. They're contracting a third-party administrator. And there are some carriers that may act as a TPA, or it could just be a locally operated TPA. But the employer is contracting with that third-party administrator to get access to a network and for the payment of claims. The employer is using the premium from the employee to pay for the TPA, stop loss coverage on their medical claims, right? So if somebody has a catastrophic event, they're in comatose and in the hospital for 200 days or something like that, that is going to hit their stop loss so that they're not paying all of those claims, right? There's a certain level where that stop loss will kick in. But the employer has far more flexibility in designing these plans because they don't have the same requirements that a fully insured product does. And then there's a bit of a hybrid, and that's level funded. So sometimes referred to as partially self-funded. These plans tend to be more popular in the small market space. And the idea behind this is that you're balancing the risk between the employer and the insurance company. There's a level amount of premium due each month to cover expected claims, stop loss premium, other admin costs. And when that at the end of the year, if claims are lower than expected, some level funded carriers may actually even issue a refund to the client. That's not guaranteed. It depends on the program. But if it's higher, right, rates are going to go up for the following year. So there's incentive, right, to have a healthier population and keep those claims lower. But similar to a fully insured plan, because it's not truly self-funded, there's more limit in what they're able to do for their plan design. The next concept here is directly tied to self-funding, and that's reference-based pricing. So reference-based pricing is another trend or model that emerged as a way to help control rising healthcare costs. But this was also focused on introducing some transparency into how hospitals are paid and pricing and so on and so forth. The idea of reference-based pricing is taking the fee schedule set by Medicare, and Medicare is the federal government, right? Providers are not allowed to negotiate with the federal government. The federal government says, this is how much we're going to pay you for this service. That's the amount that they receive, right? And the term in the industry is actually referred to as accepting assignment. If you accept assignment, means you take Medicare, Medicaid patients, and you accept the assignment of that fee schedule. Providers will negotiate higher returns, right, from private insurance. And there's a number of reasons for this. Part of it is building, lost revenue from Medicare, Medicaid patients, dealing with uninsured patients and recouping costs there, admin costs, so on and so forth. So they price their services much higher, knowing that the insurance company is going to come in lower and they're going to meet somewhere in the middle. But even still, despite all that negotiation, private insurance still reimburses significantly higher than Medicare. So when members are contracting into one of those larger networks and a self-insured employer, a self-funded employer, they're now paying those reimbursement rates of a private insurer. Now, there's still going to be some cost savings, right, in a self-funded model, but on a reference-based pricing model, those cost savings are significantly higher. Because in that situation, rather than taking a fee schedule that's been set by a PPO or another network, what they're doing is negotiating with each provider a reimbursement based on a percentage of Medicare. So what they're saying is, okay, Medicare pays you this much. You accept that amount, you're profitable on that, right? You make money. We're not going to pay you 300% of Medicare like Blue Cross Blue Shield does, but we'll offer you 150%, right? So they're getting 1.5 times what they would if that same patient received care and was insured on Medicare, right? Now, the provider has some options at this point. They can choose to say that sounds fair. And in fact, I want to create what's known as an alliance contract, which means anyone that's on your plan that comes to my facility has a full fee schedule, and there's not the co-pays, co-payments, deductibles, all of that is going to match. We now have an alliance contract on costs and reimbursement of services. They could say, I'll do a single case agreement. I'm not agreeing to this universally. And now they've negotiated a single time with that, and there's no additional cost, or the provider can balance bill the member. And this is the largest pain point as it relates to reference-based pricing. But that's where the TPA and the claims administrator come in. Because if they receive the balance bill, the member should be sending that to the TPA to negotiate, right? Or to work on getting that care in place. And that's why it's so important to have a strong education program as it relates to reference-based pricing programs, because there's more work that the member needs to do to make sure that their cost sharing matches, right? So there's going to be cost savings around the board, but that concierge service, right? The ability to work with that TPA is critical to making sure the member experience doesn't result in a large pile of balance bills. It's nearly impossible to eliminate balance billing, but with good TPA partners, reference-based claims repricers, you may already tap into an existing network of alliance contracts and not have a significant issue there. The next concept we're going to take a look at here are the types of deductibles and out-of-pocket maximums that you can have. And you might be saying, Kyle, I don't really understand what you're saying. Are you talking about single or family? I usually just see a single deductible or out-of-pocket maximum in my card. This has to do with when you have dependents covered on a plan and what the cost exposure on that deductible or out-of-pocket maximum is. So there are embedded structures and non-embedded structures. A non-embedded, let's start here because it's the simplest to explain. If you have a non-embedded structure, that means if you have any covered dependents on your plan, so you have employee children, employee spouse, or family coverage, you now have a higher deductible, right? So typically the way it works is if the deductible for an individual is $1,000, the family deductible is $2,000. You have to meet the full deductible before any coverage kicks in. Simple as that. One person, let's say they have a serious event, the full $2,000 deductible applies. On an embedded structure, there is an individual deductible embedded inside that umbrella deductible of the family plan. Think of this like stop loss coverage for an individual. The idea here is if one person has a significant event, they're going to consume most of that deductible. And in high deductible situations, that can be a pretty significant bill. When there's an individual deductible embedded inside of the family deductible, the co-insurance, co-pays, other pieces will kick in as soon as the individual deductible has been met for that member. And I know that this is confusing, so I've got an example here that hopefully will illustrate this better. So let's say that John and his wife have 2 kids covered on his plan. The plan deductible is $2,000 for a single, $4,000 for dependents or for a family bill. The out-of-pocket maximum is $4,000, $8,000 respectively, and John's son has appendicitis, and the total cost for that surgery is $8,000. Okay, so with an embedded deductible, John's family deductible is $4,000, but the co-insurance on the plan is going to kick in starting at $2,000. Okay, the reason for this is that the individual deductible embedded inside of that is $2,000. So once that $2,000 has been met, co-insurance kicks in, and then that will start counting towards that other portion of the out-of-pocket max for the year. John's going to pay a total of $3,200 in this situation. $2,000 for that embedded individual deductible, right? Then $1,200 in co-insurance. So there's $6,000 in total cost, or $8,000, excuse me, in total cost. $2,000 has been deducted, and then there's 20% co-insurance on the remaining cost, which is $1,200, which then brings his total to $3,200. His son has met his deductible for the year. That has been taken care of. The rest of the family must collectively satisfy the remaining $2,000, right? Because there's still another $2,000 remaining in the family deductible. But John's son with appendicitis has already satisfied $2,000 of it, and the plan's saying you're not going to spill into the rest of this. That remaining $2,000 is now divided up amongst the following members of the plan. On that non-embedded structure, John's going to pay $4,800 because $4,000 is the family deductible, another $800 in co-insurance, right? 20% of 4,000 is $800. Now there's no deductible left for anybody in the plan that year because the family deductible has been met. So now if John goes to seek care or something, co-insurance, co-pays are going to apply immediately. There's no longer remaining deductible to satisfy. So again, the idea here is to help limit the cost of one person on a family plan, the immediate out-of-pocket cost, I should say, for one person on a family plan in the event of a significant health event. Minimum essential coverage, I mentioned this before. This is a concept that comes through the ACA. It's important to understand and navigate. So the Affordable Care Act requires that if you have at least 50 full-time employees on average for more than 120 days in the calendar year, you have to offer a group health plan that meets the requirements of the Affordable Care Act. And the first of that is a minimum essential coverage requirement. There are certain services that are specified in the law that a group health plan must cover. And then in addition to that, certain essential services that must be covered without any cost share to the member. So the insurance company pays 100% of that cost. This is things like your annual physical, immunizations, the certain health screenings for depending on your age, right? So as you get older, colonoscopies fall into that, mammograms, so on and so forth. And then certain medications as well, blood pressure medications, other things like that, common preventative medicines that can prevent more serious health episodes in the future. The law requires are covered in full by the insurance company. Now, the law originally included a tax penalty for adults that didn't carry health insurance that met the MEC requirement. And that spurred the creation of MEC-only coverages that allowed employers to offer a very low-cost plan. It only covered those minimum essential pieces that are fully required by the law, and avoid both employer and employees from paying a penalty in that scenario. That penalty was removed by Congress in 2019, but you're still going to see MEC plans offered. Typically, we see these in more low-wage, high-turnover industries like fast food franchises, hospitality, home care, home health aides, things like that. But you will see this move across. But understand as well that that individual mandate has been repealed, so there's no longer that tax penalty for those who do not carry a MEC plan or a plan that meets MEC. This is showing you those minimum essential coverage requirements. Healthcare.gov has a more detailed listing of those essential services, but ambulatory patient services such clinic services, emergency, hospitalization, pregnancy, mental health, prescription, rehab services, lab services, preventative wellness, and pediatric care. So those are the essential categories. And then it's not saying all of these are covered without cost share. Those specific services are defined and outlined in more detail. Minimum value. So another portion of the Affordable Care Act's requirements is that not only do they have to have a MEC requirement, but the plan must meet the minimum value standard. That's about as clear as mud, right? And there's a very, very long IRS article and calculation that meets to that. But essentially what it comes down to is the plan is designed to cover at least 60% of the total cost of medical services for a standard population. So the idea here is that the plan is going to cover at least 60% of that cost. The remaining 40% would be the member's responsibility. Another requirement to this is that the benefits must include substantial coverage for physician and inpatient hospital services. Now, that is it's hard to find the actual word definition of substantial coverage, but there is an evaluative process the IRS follows for this. And again, that's documented. But the idea here was they wanted to avoid plans being designed that would cover 60% of the total cost of medical services in a standard population. But depending on how you balanced out where those payments were, having very little coverage at all for inpatient stays or hospitalizations, and then somebody has most of their ambulatory care well covered, but they end up in the hospital and they're bankrupt. You may see some employers who offer a minimum value plan or an MVP plan. And the idea behind this is typically, again, larger franchise operations where there's a mix of wage right across the board. But the affordability threshold, right? Some employees may not be able to afford because it's not going to meet the requirements of the law. It's 9% of discretionary income that employees can spend to meet the ACA requirements. And the plans that are offered for most of the population that's participating aren't going to meet that requirement. So they may offer a separate MVP plan that's a much lower value, but still meets the requirements of the law. Typically, these plans have lower participation and are mainly designed to avoid a tax penalty. But that's going to be something to talk through with your risk advisor. Now, coordination of benefits. So this is the last thing that we want to tackle here in terms of concepts. And this is important to understand just as employees navigate care. It's very common that an employee may choose to be covered on two separate plans. That could be, they're covered by their spouse, someone who's younger covered by their parent, or they have Medicare coverage, but they're still enrolled in your employer-sponsored plan. So there's rules for coordinating these benefits. So Medicare has its own part, so we're going to start with just the private insurance. The non-dependent dependent rule, this is fairly straightforward. The plan that covers an individual as the enrollee or the subscriber is the primary payer, because your insurance companies are going to have to know and notified that you have more than one coverage, and they're going to coordinate on the billing of those expenses, right? So when your provider sends in the claim, they're going to list a primary payer and a secondary payer. The claim gets processed through the primary payer first, then sent to the secondary payer, and then any remaining cost share is assessed to the member. Now, if you're taking a plan through your employer and you're covered by your spouse, your coverage is always going to cover you first, to be primary. Active versus inactive rule, again, fairly straightforward. The plan that covers an individual as an active employee or the dependent of an active employee is the primary payer over a plan that covers an individual as a retired or laid off employee or the dependent of someone who's been retired or laid off. So essentially, if the primary subscriber is an active employee, And the secondary plan, the primary subscriber is not, is retired or laid off or so on and so forth. The one that covers individuals and active employees always can be primary. The birthday rule. This is probably the most fun one. And this is not a law. This is set by the National Association of Insurance Carriers, and carriers just adopted as an industry standard. But what the guidance states is that for determining the primary coverage for dependents, the primary payer will be of the parent whose birthday falls first in the calendar year. And this isn't who's older, right? You could have someone who is, 45 years old with a spouse who's 48. Let's say the 45-year-old has a birthday in November and the 48-year-old has a birthday in July. The person whose birthday is in July is going to come first. Just flip that around. I realized in my example, but it's based on the date that falls in the calendar year, not the age of the parent. So that's what's going to determine whose plan pays first for their kids. And many parents are not aware of that. Rules for coordination of benefits under Medicare. Medicare by law is the payer of last resort, which means in the except rare circumstances, the private insurance is always going to pay first, right? Medicare is a publicly funded program. They're going to require private insurance companies to pay before that publicly funded program does. If an employee is enrolled in Medicare and the employer-sponsored health insurance, the health insurance is going to pay first unless the employer has fewer than 20 employees. Cost sharing with secondary coverage. The key thing I want to stress here for everybody is we talked about those high deductible health HSA compatible plans before. Members are still responsible for any deductible on their primary and secondary insurance before the plan will pay benefits. But more importantly, secondary coverage will not pay towards a primary plan's deductible. You have to satisfy your primary plan's deductible before your secondary coverage is going to pay anything, right? The idea behind this is that your primary plan, you've accepted that cost exposure. You're responsible for that. Your secondary coverage is going to be only kick in once that's been met. So if somebody is enrolled in an HSA compatible plan to try and have lower premium, but didn't take an HSA or anything else to help cover it, banking on their secondary coverage, which is not HSA compatible, or is a copay plan, banking on that to cover it, they're up a creek without a paddle because they're going to have to cover that full high deductible cost before their secondary plan pays anything. And that's what this last part here is. After both deductibles have been satisfied, the secondary insurance is going to be billed for those costs. So want to leave a couple minutes here for questions before I turn it over to Valerie. So Amy, it looks like we got a couple in the chat. And oh no, Amy, that was yours out there. So I'll turn it over to you to facilitate Q&A.
Yes, absolutely. Thank you so much, Kyle. We have a few questions that were submitted early. So the first one says, we are considering offering our employees 2 medical plans so they have the option to pay less in premiums and have more take-home pay. However, I'm concerned if they have to utilize the coverage, they will have to pay more out of pocket by having lower coverage. When would you recommend a company offer 2 medical plans, if ever?
So I'm a big fan of choice. As long as there's a good education program in place to help employees understand those costs, right? There's nothing wrong with having a higher deductible exposure on a plan, as long as employees fully understand what that cost means and what tools are available to help evaluate that, right? And help cover that cost. So what I mean by that is in those higher deductible plans, right? You can sponsor an HSA via payroll deduction. So employees who may enroll in that lower cost plan and certainly do have a higher cost share component of it, right? Can tuck away dollars that would be paid to premium on a higher plan into the HSA to help cover those expenses, right? And those dollars follow them. You can offer voluntary products like a hospital plan or a critical illness plan, accident plan, others that are going to pay cash benefits to a member if they have a health event while they're on this plan, and they can use those plans to cover the cost. And these are significantly lower cost coverages, right? We're talking $10, $15 a paycheck in most situations that are going to help cover that place, right? So I would caution you against not offering a lower cost plan simply because there's higher cost exposure on it. Some employees may prefer that, right? They may be looking for a plan that goes along with it. I think the key thing ultimately comes down to education. How are we delivering that to help employees understand what those options are and how to navigate that care?
Very good. I think your question or your answer might be similar. I've got one more and then we're going to turn it over to Valerie.
Sure.
This says, would you suggest employers contribute to HSAs to encourage employees to utilize that type of plan?
Yes, I do strongly recommend that. And it also can be a creative way to build comp for employees, right? That is a pre-tax contribution, right? That's in place there as well for you and the employee. And you can space out how those contributions are deposited. Could be per paycheck, monthly, quarterly, all annual as it is in place, but you're going to see more robust participation in those high deductible plans if you have that employer contribution to the HSA. And if you do the math, you may even find out that it's less expensive for with your employer contribution to that premium, and then your contribution on the HSA than your outright employer contribution on the more expensive medical plan.
Interesting. But again, it all comes down to education.
100%. Yep.
Sure. Okay, I'm going to turn it over to Valerie now to go over the specific details of the plan. Valerie, welcome.
Thank you for having me, Amy. So we're definitely excited to be able to present part 2 of this webinar. Is a little bit more detailed as far as the offering that is currently. Can you see my screen? Can you see that?
I can. I'm so sorry to interrupt you. I have a couple of questions that were also submitted earlier about this too. So whenever you're done, just let me know and I'll go back and forth with you. Yes, but I can see this. Thank you.
Okay, perfect. Okay, so as I was mentioning, part 2 of this webinar is going to be a little bit more detailed. It should be about another 10 minutes of your time. And this is going to go over the specific benefit offering through the Arizona Chamber. So in this particular, and it's perfect, right? Because Kyle already touched on what a lot of this terminology means, but we'll make it as simple as possible. So some of the features of this benefit program is that it's lower premium than your traditional plans. There's no deductible options. It's guaranteed issue following that the group is actually approved. What happens a lot of times on the small employers is that every individual is their rate is based on their age. In this particular case, it's composite rates. As long as the group is approved, all we need are a minimum of 2 employees to enroll. It's open access. That means that there's no network required. And all of them have unlimited telehealth, teletherapy included in their plan. You're also going to see that it does have a discount diabetic supply program, and it has a 4-tier prescription plan, but over 600 generics would be at $0 copayment. So it's all win-win. Part of this benefit package is that we will also offer some voluntary benefits like the dental, the vision, and some plans that pay cash directly to the employees to help with some of those out-of-pocket expenses, like an accident plan, critical illness. So we are able to offer a variety, a complete benefit package by using, as Kyle mentioned and Amy, enrollment and education resources. So you get assigned a personal implementation consultant. So as a small employer, there's no paper applications. You don't have to provide all that education and try to get the employees to understand these plans. This implementation consultant actually does all that work for you. So everything is done virtual, one-on-one with a dedicated benefit counselor that will be trained specifically on these benefit offerings. And then they get to meet with you first and find out exactly, what is the eligibility for your employees. So all that is built ahead of time. So once they meet with your employees, we know exactly what is being implemented. We do use a variety of communication tools now that we're in the virtual world. So we do send customized videos, text messaging with links to be able to schedule with a benefit counselor. And best of all, To be able to offer all these great plans and different carriers, we do offer something called consolidated billing. So that is included in your benefits. And what that is that you will receive one invoice every month with all your carriers on there. So you don't have to worry about directly having to log into each company to be able to process, payroll and make payments. So that's part of that. So a little bit about HBA. I'm going to go ahead and share sound once. Stop sharing. This video I think is great because it does give you a very quick overview on what is the difference with these HBA plans.
Is this scene familiar to you?
My deductible is bigger than my bank account.
Prescription drugs are too expensive.
I can almost run my whole life on my phone. Why can't my health plan keep up?
Hey, are you tired of listening to the same boring benefit story? Me too. So let's check out something different. First, let's look at the definition of benefit. Something that is advantageous or good, or that promotes well-being. So why is it that today's health benefit plans so often seem to have no benefit? Like, when you actually need care, why is there this enormous deductible you need to conquer first? At the Health Benefit Alliance, HBA for short, we're working to change all that. We're working to remove the barriers to care that may have prevented you from seeing the doctor you want when you need to, or maybe turned you off from health plans in general. That's why we design plans to help you balance your personal budget and your medical needs. For example, the vast majority of our plans have no deductibles, only copays, so you can get benefits for care when you actually need it with the ease of a simple copay for both in and out-of-network doctors. When your employer offers HBA plan designs, you can use any qualified doctor you choose, and virtual care and most generic prescriptions cost you nothing.
That means convenient access to doctors wherever you need them, including primary care doctors and licensed mental health therapists,
and over 90% of the most commonly prescribed generic drugs at no cost. And even vision benefits, so you can pick up some cool specs whether you wear prescription glasses or not. So, you like where this is going? Copays instead of deductibles, no-cost generic drugs, and use any qualified doctor you want. We're talking affordable choices with benefits you can access without draining your finances. Want to learn more about plans you can afford to choose and afford to use? Then let's check out the health benefit designs available to HBA clients.
So as I mentioned earlier, what happens with a lot of these medical plan options out in the market is that a lot of times they have a very high deductible. So employees sometimes have to maybe pay $300, $400 to go to the doctor. So the average employee sometimes, doesn't have that. So what they do is that they don't normally either participate in the medical plan because it's too expensive, or they don't use it unless they absolutely have to. So these plans that we're going to go over today, what they do is that they provide access to those employees. They're definitely not going to be for everyone, but it is a great option to be able to offer that and make sure that every employee has access to it. There you go. Oh, okay, so these are the two options. There are 4 options available. These first 2 would be the bronze plus and the gold. These are your limited day medical. And these are some examples. These rates are based on state. So these rates can vary, but this is a close estimate of what the rates look like. So for an employee cost in this particular case, you're looking at about $464 a month on that limited day medical plan. And what does that mean to you? Limited day means that there are some limits on the benefits. So for example, on the primary care visits, it is a $25 co-payment, and it's going to cover 8 visits per year per person. On the gold, usually it covers the same service, but that limited maximum is a little bit higher. In this case, it's 12 per year per person, and then your copay is lower. So both of these plans work very similar. What it does is that, again, it allows us to keep the cost down by putting these limits on the plan. And most people don't go to the doctor more than 8 times a year. And if it is an employee that actually does, this is probably not a good option for them, which is good, which is okay. For the specialty visit, it's a $50 copayment to the specialist, 8 visits per year. Urgent care would be $50 copayment twice a year. If an employee does have to have lab work or x-rays, it's $50. For outpatient surgery, it's $350 per visit, 1 per year. In the case of hospital services, if they are admitted in the hospital, they're going to pay $350 copayment per 5 days every year. So let's say if you say an employee is in the hospital longer than 5 days, what happens in those cases is that HBA is going to negotiate that contracted rate directly with the hospital, but they will not cover. So they will provide that, contracted rate and help lower the actual cost for the employee, but that employee would be responsible for everything above those day limits. Okay. In the emergency room case, this would be $350 copayment, also 1 visit per year per person. So as you guys get it, everything is copayment, everything is covered, but it does have some limited benefits. Limited maximum of visits per benefit. And as we mentioned earlier, there's over 600 generic medications that are at $0 copayment. If they did fall under tier 2, then it is a 20% coinsurance, which means that the employee would be responsible for 20% of the contracted rate, and then anything above that would be covered by HBA in this particular case. Okay. Your more traditional plans in this case would be your PPO and your high deductible plan. So your PPO in this case does have, for example, a copayment. So in network, it would just be $20 to the primary care doctor, $40 to the specialist. The difference here is that there are no limits, right? So you just continue to pay for your copayment. It does have a max out of pocket. So what does that mean? Once that the employee reaches $2,000 for an individual in that year, including all those co-payments, they don't pay anything else, but the cost for an employee is double. Okay, so that is why, because it is unlimited. In the case that they were admitted in the hospital, in this case, it's a $400 co-payment per admission. Emergency room is also $400. Now on your high deductible plan, it's a little bit more in the middle of your PPO and your limited day plans. In this particular case though, the employee is responsible for the entire deductible, which in network would be $5,000. That means, let's say they go to the primary care doctor and that contracted rate is $300, they would have to pay the full $300 until they have reached the maximum of $5,000 for that year. Once they have paid $5,000, everything else is covered 100%. So that's how really your high deductible plan works. Okay, your limited day medical plans do have some limitations, as I mentioned, on the day limits, but also chemotherapy and radiation are excluded on your bronze plus and your gold. Kidney dialysis is also excluded, and specialty prescriptions. In order to help, if these are some of the employees' concerns, we do offer different voluntary plans available to them. So for example, they are able to complement that limitation by adding maybe a critical illness plan with AFLAC. And what that does is that upon diagnosis of cancer or heart attack, that employee can get up to $75,000 lump sum benefit. So it doesn't necessarily pay the entire bill, but these are some of those additional voluntary plans that are still very affordable and still keep the cost of healthcare down if they combine it with some of those limited day medical plans. And that's kind of where that education comes in. Those employees are going to be able to speak with a benefit counselor and be able to explain to them what their history is. Like, I had a family history of cancer, so maybe that's more important than to somebody else, right? And it depends on their age and their family status, of report. So what they do is that depending on the number of employees that you currently have in your company, we do have several different companies, as you see here, that are able to provide quotes as low as 1 employee. So there are different options depending on the need of your employer. Once you do schedule a time with your implementation consultant, they go over what we call a group health questionnaire. They ask you a few questions. They know automatically whether your group is approved or not. And then at the same time, they're able to send you a formal proposal that includes the rates for all these carriers, including your final rates on the medical. And a little bit about the education, as I mentioned. So your first step is really to book an appointment with the implementation consultant. I believe that the link was in the chat earlier. And Amy, you're going to also be sending a follow-up email. What that one-on-one consultation does is that they review any questions you might have on these particular plans, and then also ask you a couple of questions to be able to send you a proposal, which has the final rate. And they'll be able to also set up a strategy about whether you want to contribute to the plan or not. What's great about these HVA plans is, as an employer, you do not have to contribute anything. But I think Kyle mentioned it a little bit earlier. Of course, the more you contribute to the plan, the better the participation. However, as far as HVA, we do not require a specific contribution as an employer. So with your consultant, they'll be able to order your customized posters, your videos. And then, as I mentioned, the employees do get customized text messages with a link that they can schedule with a benefit counselor and do their one-on-one consultation. So a lot of that just makes the whole process much easier for you. All you really have to do is pick and choose which medical plan will be offered to the employees. Okay, I think that's it, Amy. I'll turn it back to you.
Yeah, thank you so much, Valerie. I will say from personal experience, we at HR Simple use this insurance. I have personally gone through this process, and it's so much cheaper and easier than I've ever experienced health insurance to be. I was very nervous because I have a family, but yeah, it was just really seamless and like one of the best experiences I've had with health insurance. So okay, we have a couple questions. I know we are at 1 o'clock here, so obviously we'll do this as quick as possible. So the first question is, can we use this in addition to our existing group plan?
Yes, you are able to offer this. You're also able to choose a particular group or population of employees. So for example, if you want to offer a more robust benefit packages to your managers and then offer this to your hourly employees or your part-timers, you are able to do that. So you can definitely section it out and tell us who do you want to offer these benefits to.
Yeah, that's a great point. To just, I guess, to reiterate that this plan is available to part-time, full-time, and independent contractors. Is that correct?
Absolutely. That's
okay,
correct.
There's no restrictions on the type of employee.
No.
Awesome. Okay. One of the last questions we have is, we have employees in multiple different states. Can these plans be used throughout the US and its territories?
They can, absolutely. It is available.
Okay, awesome. And I just also want to specify that there are no restrictions, depending on the region that you're in Arizona. I know that a lot of plans work that way, but there are no restrictions.
No restrictions.
Awesome. And then the last question we have here is there, I think you've already mentioned this, but is there a minimum number of employees who need to enroll in health insurance in order to participate? And does that number is that number different for supplemental insurance offerings?
So it does depend on the carrier, but that is why we normally offer on the voluntary plan, we will pick the carrier that offers the minimum participation depending on your employee count. As far as the Health Benefit Alliance benefits, we do need a minimum of 2 employees to participate.
Okay,
Yeah.
2. Awesome. Okay, well, that wraps it up for the questions. Thank you so much, Valerie. I know that Kyle already had to run, but thank you everybody for joining us today. I will be sending out the recording of the webinar and the copy of the slides and the link just in case you missed it along with the credit code. So thank you all so much, and I hope everybody has a wonderful day. Bye-bye.
Thank you.